Welcome back to Switzer. It's now time to get inside the head of Roger Montgomery of Montgomery Asset Management. And who doesn't want to do that? So what stocks does he like right now? And could there be an opportunity if the Aussie dollar comes off the boil in the next year or so? That's the question I posed to him. I expect him to disagree with me, but still, that's what we're doing tonight. Hello, mate.
I don't always disagree. It's not automatic.
No, but you often don't like big order issues affecting stock selections. You don't like macro.
Yeah, but Aussie's going to have a, if the Aussie does drop, and I'm personally short lots of Australian dollars and have been since $1.02. Most of my term deposits.
Well, I'm glad we've got Unity. It's great we've got Unity.
Our family term deposits have been sitting in Singapore dollars and US dollars now for over a year, well over a year. So we've seen it go all the way down to, 87 or thereabouts, and back up to 94.
And Comsec's got a 97 out there.
Oh, well,
that was before the inflation number.
We're not in the business of forecasting, so,
That's the hardest thing of all the forecasts.
But having said that, I do agree with you that and Australia needs the Australian dollar to go down. Competitively, it has to. So we'll see.
OK. Quickly, I want you to have a quick look at the Westfield rejigging thing. Do you have a view on that?
Yeah, look, the question that arises, and I've got to be careful what I say here, but the question that arises for me is that I wonder whether or not shareholders would have been better off if the original 1990 structure stayed in place. Now, my guess is the shareholder register might have changed quite dramatically if that structure had been maintained.
Yes.
But I think shareholders might have been better off. Now, we don't own Westfield. We haven't owned either of the Westfield securities because the company hasn't been able to recently demonstrate to us that it generates the kind of returns that we demand for a small portfolio that we run. We're only running $500 million. We can afford to go down the market capitalisation spectrum and find things that are really, really attractive with duopoly kind of situations. And admittedly, Westfield has geographic monopolies, which is attractive, but I worry for the bricks and mortar shopping centres. I do worry for those. I have heard some learned and experienced retail experts say to me that what will happen is going out to a shopping centre, it will be an experience. You'll go out for the day, you'll go to a spa, you'll go in the morning, you'll go to a gym, then you'll go to a day spa or something like that. You'll have a coffee, you'll have some lunch, you'll catch up with business colleagues and whatever. I'm not sure that's right, and I think whatever future is in store for shopping centres, I do believe that we might find that the rate of increase of yields or incomes, rental incomes, isn't as fast as what it once was.
Yeah, I agree with that, I think, Matt. So generally, Westfield,
doesn't meet our hurdles.
Certainly, I guess if you're chasing yield, it's okay. But you're even raising question marks over yield in the future, aren't you?
Well, and they're not fully franked. No. They're not fully franked dividends either. So.
No, good point. Okay. So, are there any companies out there that you think? One. So there's one company where the intrinsic value is greater than the market.
Normally you expect me to say, no, not at the moment. It's all too expensive.
Well, you throw JB Hi-Fi because it has been.
So one of the things that you can do in investing is take advantage, and it's a valid investment strategy to take advantage of what are called market inefficiencies.
Yep.
Where there's not a long history, people believe there's insufficient information to make a decision, so you get inefficiencies in the market, you get mispricing in the market. New floats are a classic example of that. You sometimes get situations where people scratch their heads, they don't know the business that well, they haven't heard of it before, and so on. So the business that I'm going to talk to you about today that we believe is a great quality business, that we also believe is below our estimate of intrinsic value, and we own, has only listed today, right now, and it's called Burson's. Now, Burson's is the conduit between the manufacturers and wholesalers of aftermarket car parts and the mechanics, the Midas and the Kmart mechanics, the big network mechanics, as well as the independents. There's a very stable, enduring duopoly situation in that particular channel, and that is between Repco and Burson's. But a lot of people haven't heard Burson's, so I can hear people listening to me talk about them right now, going, "Oh, come on, Rog, Burson's, I haven't heard of them. I'm not that comfortable with them."
Rev heads would know.
Precisely why there's an inefficiency in the market. So we bought them in the float at $1.86. They've listed today today around the $2, $2.05 mark. We're happily buying them below $2.10. We reckon they're worth $2.44. The return on tangible capital, there was a private equity purchase of the business which involved a lot of intangibles on the balance sheet. Yeah. So when you've got a lot of intangibles on the balance sheet, you want to look at the return on tangible capital. Yeah. That's risen from about 8% a decade ago or thereabouts to about 28% now, which indicates to us that they're gaining some scale efficiencies from their distribution centres. So as they get bigger, they're making more money.
No risks from the fact that manufacturers will...
No, because this is aftermarket mechanics.
Good.
Right? Okay. Everyone's still driving cars. Yeah. Everyone's still...
You got a car, something goes wrong, you just...
Exactly. Okay. Now, so that's an example of a business that ticks all our boxes. Yep. Is small. Most people are doubting me, which is precisely why we can buy it cheap.
Okay, good. Yep. Fantastic. Burson's. Now, I also asked you to have a look at companies that could benefit if the currency fell. Now, in my feeling is I wouldn't be surprised if the currency goes as low as 80 cents over the next 2 years.
I don't know if you're going to be correct, but I hope you're correct.
Yeah, and I wouldn't be surprised if it ends up only being 85 because the China factor could keep the currency from going too low. But Adam Boynton from Deutsche Bank, I don't know if you saw his call, he got a 66, 69 US cents. So, well, if
the Commonwealth Bank saying, what do they say? 97, and you got, it's a big spread, isn't it?
A big spread.
McKinsey's did a study on currency forecasts some years ago, and they worked out that strategists who forecast currencies are about 100% wrong.
Yeah. Yeah.
Roughly.
Yeah.
Roughly 100%
Simon, when I do my economic presentations at conferences, when it comes to the dollar, I say, I'll confidently tell you the dollar's going to go up, down, or stay where it is. Because as a person who understands the theory of foreign exchange, often the currency goes in the opposite direction to what theory tells you.
Well, it's driven largely by sentiment. If you go to any dealing room or treasury dealing room where they trade currencies, you'll see a bunch of very, very intelligent people who've got very high marks at university and at high school, sitting there looking at charts.
And the cricket.
It's an oxymoron. You've got smart people doing stupid things. But anyway, there you go.
All right, mate. Now, let's talk about some companies that you think look like they could benefit from a lower currency.
Yeah, okay. So some obvious ones. Yeah. Companies like CSL. Yeah. I'm going to talk about, look, there's a lot of businesses that will because they're moving offshore. Yeah. But I'm going to talk about those businesses that we believe are very high quality and are not necessarily very expensive compared to our estimates of their intrinsic value, and they're going to benefit.
So the gap between the current market price and intrinsic value
is narrow.
Is narrow.
Some of them
so if the currency falls, it could improve the intrinsic value.
Even
okay, good. That's exactly what I wanted to do.
So CSL, number one.
Okay.
Flight Centre.
Yeah.
Now, everyone thinks about Flight Centre and they say, oh, well, look, if the currency drops, there's going to be less outbound travel from Australia, and therefore that's bad for Flight Centre. That used to be the case. It isn't now. Their business is expanding globally. They're growing very, very quickly in the United States, and it isn't the currency that drives foreign travel from Australia. It's the price of airfares. Yeah. And if airfares are cheap, and they will be cheap because if the currency drops, people may not want to travel, so they'll drop the price, people will travel. Right? So Flight Centre will benefit. Yep. Ainsworth Gaming, growing at a phenomenal rate and expanding into South America, into the United States. They make poker machines. You may or may not want to own poker machines.
Yeah, you have a philosophical thing against it.
Yeah, and that's fine too. Yeah. But they're growing at a very...
You actually wrote a story about Ainsworth for us. You really think they're heading in the right direction?
Oh, absolutely. Yeah. Absolutely.
Is Len still there?
Len is still very much there. 86, I think. 86.
And he had a big blow up with his family with the original business.
Yes.
He's just reinvented the whole thing.
Well, he's just done it again with it, and he
must get Len on the show.
You should.
Yeah.
I'd love to sit in.
Yeah.
Love to see him ask me some questions.
You'd take over. But
no, I wouldn't.
Yeah,
no, I'd be happy. I'd be happy to sit in the background and just listen.
Okay, right.
Car sales, another one, expanding offshore, made the acquisition in Asia.
You've got confidence in what they're doing offshore? You would have investigated pretty carefully?
Yeah, we have. We own it. We like it. You know, what's happened interestingly with that business is you had some of the big manufacturers like Honda, for example, and I think even Mazda, pull their new cars, the manufacturers, the OEMs, told their dealers not to sell new cars through car sales. So they pulled them off.
Yeah.
Their sales plunged up to 30% in the space of a few months, and we're noticing new car sales for those brands starting to creep up again. So either the dealers are going around the manufacturers, or the manufacturers have said, look, you know, that's the only way to go. So their moat has deepened and widened. You know, their competitive advantage is more entrenched. So we really like them. Seeker's another one. Seeker going to make a lot of money overseas, and I hope when they float that Chinese thing later on this year on the NASDAQ, their Chinese job site, which is the #1 job site over there, I hope that the Aussie dollar is very, very low, because there might be a capital return in US dollars, and that would be, I think, very good. So
a lot of people ask me, have we missed the boat with companies like Seek and car sales? You're arguing convincingly.
Well, it's interesting.
No.
People look at the share price, and Warren Buffett always said, never take your cue from share prices. You know, the share prices run hard. It's gone up a lot, but the value of this business isn't $16 in 10 years' time. It could be $50 in 10 years' time. It's currently at 16.
We've considered the same thing to me as well.
Right. So you know, the value of the
people
business
go chasing cheap stocks. He said, but you know, a $20 stock can rise by 10% just as easily as a $2 stock.
Now, to be fair, I don't know what's going to happen to the share price between now and the next 10 years. I don't know if it's going to halve first before it gets there, but I think the business will continue to retain profits and generate very high rates of return on those retained profits, and that's how businesses increase their value. If I've got a bank account with $10 million in it today, earning 20%, and I auction that bank account to all the viewers, they're going to bid more than $10 million for that bank account. In 10 years' time, if it's got $100 million in it and it's still earning 20%, and I bring it back to auction, not only am I going to get more than $100 million for it, I'll get more than what I got at the auction today. Yeah. So the value goes up, and businesses that retain profits in their equity through retained equity and then generate high rates of return on that retained capital, they're going to increase their value. It really is that simple, and we're trying to find those businesses. So I've given you a list of businesses that I think can actually do that. Kathmandu is another one. Kathmandu.
Do you like Kathmandu?
Kathmandu, I believe, are doing a really good job with their memberships. People say, oh, you know, their product's always on sale. But if you walk in there and you're a member, you don't pay the list price, and that's part of the attraction, being a member. And that they're getting increasing numbers of members from overseas, and they haven't even started marketing overseas.
Fantastic, Roger. As always, delivering. That's what Roger Montgomery does. Cheers, mate. Fantastic. If you want to read my thoughts each morning at the close of Wall Street, check out my website, switzer.com.au. And if you have a self-managed super fund, have a look at the switzersuperreport.com.au website. Roger writes for it as well. And if you've got any questions for me, or ones you'd like me to put to an expert like Roger, email me switzer@switzer.com.au. I'm Peter Switzer. Thanks for joining us. Have a great Anzac weekend.